So without further ado, let's move to the last session of this very nice conference, which has the title Policy Interactions. And believe it or not, in a central bank, it is the role of a financial stability department to also look at the financial stability implications of the monetary policy that is done in another area of the central bank. And this session today is actually a very good example what you can look at. So we have three examples of things what you can look at, but don't take this as because there's a lot about unintended side effects outcome. This is not a soul-searching session. It's about a natural business, and don't forget, in the end, the conduct of monetary policy has to be a result of a proportionality assessment of pursuing our primary objective through the monetary policy, in monetary policy, subject to other effects that the policy might have. And here we will mainly hear about some aspects of some aspects of the proportionality assessment, but it will also have to look at, obviously, the proportionality assessment of the benefits in terms of achieving the primary goal of price stability, the monetary policy objectives, which is not the main objective, the main topic of this session. So please keep this in mind all the way through. First to talk, Bruno Albuquerque, with a very nice paper, which we know already from the CHAMP network, our monetary transmission network. So we have a new channel through the health of firms, monetary policy transmission through the health of firms, so-called zombie firms. You have 25 minutes, please.
Thank you. Thank you for the organizers. Obviously, it's always good to be back. And also thank you to all of you for staying until the very last session, including for my paper. And if you have great expectations, I promise that I will disappoint you. So this is a paper on monetary policy. We do have, a small section on macroprudential policies, but it's mostly on monetary policy and the transmission of monetary policy to the non-financial sector when you have zombie firms around. So we call it the zombie lending channel. And this is a joint work with Chenyu. She's at the World Bank. And as always, the usual disclaimer applies that whatever I say here, this is our own views and not of our employers. So let me start with a chart from a different paper that I have. So I'm going to use the data set from that paper on the zombie firms. I will qualify later what I mean by zombie firms, but generally think about unviable, unproductive firms that due to misaligned incentives on the part of lenders, they manage to survive. So in a world where you wouldn't have these incentives and frictions, these firms would be replaced by more productive ones. So when you look at the blue bars, this is the share of zombie firms over more than 60 countries that I have in the data set. And you see a general trend of the rise in zombification in the non-financial corporate sector. This from, let's say, 5% before the GFC to a peak of 10% in 2016-17. And then there is, with the recovery in the world economy, and there was a slight decrease, and the share of zombie firms rose again during COVID. And we are not going to explain the factors behind the zombification in this paper. This was done before in the previous paper and also in many other papers, that you can think potentially of the low interest rate environment that might have encouraged the search for yield behavior of market participants and excess liquidity and so on, that might have been channeled to a lot of firms, including to risky firms, these zombie firms. You can also think more recently about the untargeted policy support, mostly untargeted at the very beginning during COVID, that might have kept some bad firms around for longer. So we have this scenario. There is, heterogeneity across countries, obviously across industry, but there is kind of a global phenomenon of having increased zombification. And why do we care? Because we have substantial literature dating back to the last decade in Japan, that the survival of these bad firms, zombie firms, create negative spillovers, we call conjunction effects, on the healthy firms that compete in the same sector. You can think about crowding out effects. They compete for the same labor, leading to an increase in wages, same products, leading to a decrease in the market prices of output. and also misallocation of credit, that credit flows to these bad firms. And overall, there is kind of a consensus that in Japan, several papers from Acharya in the euro area during the sovereign debt crisis, that productivity, investment, employment is reduced in countries that have an increase in the zombie firms. And now I'm going to introduce here monetary policy. And the reason is, in an environment where you have contractionary monetary policy shocks, and does this allow a better allocation of resources towards more productive firms or not? So I'm going to combine the zombification literature with monetary policy. And one can think that potentially yes, if you think that zombie firms, is just another term for financial distress firms. So you would expect zombie firms to be more responsive to contractionary monetary policy shock. You can also think about the risk-taking channel that would become, financial constraints would become more binding for zombie firms. On the other hand, there might be an offsetting factor, which we will then test empirically and theoretically. Zombie firms might actually be less responsive. And the idea here is that, banks made credit decisions in the past, they have skin in the game, there is an increase in the cost of debt, and banks internalize that the zombie firms will default. And they might have an incentive to keep them around for longer, gambling for resurrection, gambling for the bailout of the sovereign, or that the zombie firms will turn around their business. So they might provide more credit when there is an increase in the cost of debt to keep them alive. And this is the zombie lending channel of monetary policy. The overall effect remains empirical, which I will focus my presentation on, but we also have a model in the paper that we try to rationalize this. So this is the question. We are going to look specifically at the differential effect of a contractionary monetary policy shock to zombie firms versus non-zombie firms. And we have a large panel of 47 countries over the last 20 years. And our monetary policy shock, which I will explain in a minute, draws on the US global spillovers literature. So we have the US monetary policy driving the global financial cycle, and then we will model this for each one of the countries, the change in monetary policy conditions. And our main contribution is to explore this channel whereby monetary policy transmission might actually be impaired or mitigated when you have a larger number of zombie firms. This leads us already to the preview of the results. The first one is, at face value, is a surprising result. Zombie firms are less responsive to contractionary monetary policy shocks. And we rationalize this through evergreening motives. In the second bullet, I say that we find that zombie firms' investment, employment is less affected, again, always relative to non-zombies, because we see in the data that they get better relative credit conditions in terms of quantities and prices. This is what we call the zombie lending channel. So better credit conditions, lending flowing differentially more to non-zombies when you have a contraction monetary policy. We find that this effect is stronger for undercapitalized banks. Potentially here the story is that these banks with weaker capital are closer to reaching the regulatory limits, so they will try to keep these zombie firms alive, not to absorb the losses. And the silver lining is the last point is we look at cross-country heterogeneity, and we find that countries like the US, if you have, high bank capital, if you have policies in place, macro-prudential supervision regulation, that can limit these banks' incentives to engage in risk behavior, this can help. And on top of that, countries where it's relatively fast, not costly like the US again, and other countries, to resolve firms, this also helps to mitigate this channel. Okay, let me go now into the data. We use for the first part of the presentation, the bulk of it, this is balance sheet data on the borrower side. So this is the CompuStat. I believe many of you are familiar. We have 47 countries, roughly split between emerging markets and advanced economies over the last 20 years. Then we zoom in on syndicated loans to provide evidence on supply and credit effects. So we want to control for credit and supply effects, demand and supply effects, which we cannot do with Compustat. And then we also explore country data to look more into the heterogeneity across countries, in particular looking at capital buffers at the country level, NPLs, but also using macroprudential policies with the IMF's database on macroprudential policies. And monetary policy surprises. This is standard by now, high frequency identification for the US around a very tight window of FOMC meetings. And we're going to use this US monetary policy surprise as instruments for each one of the countries, government bond yields. We'll explain in a minute. So zombie firms, now I'm going to define specifically zombie firms. So I see some people in the audience, including my discussant, that have worked substantially on that, and there are many definitions around. I think there is a consensus conceptually, risky, unproductive, and unviable firms, and then there is some differences in terms of the methodology. Here, what we do is, again, resorting to this paper that I have, is to capture two dimensions. One is financial distress, which I think it's not controversial, with the first two indicators. This is a firm that has an ICR below 1. So the internal revenue that they generate cannot pay for the interest expenses, and they have leverage above the median peer at the country sector level. So this comparison is important given that they are very leverage varies substantially across sectors, so we compare to similar peers. And the third indicator, it measures profitability. So this is very important because we don't want to capture distressed firms that are profitable. We want to capture persistently unprofitable firms. So we have real sales growth that is negative. And all of these indicators, it's for 2 years in a row. And we only allow zombie firms to leave this status when they reverse at least one of the indicators for 2 years in a row. So this means that once I classify a firm as zombie firm, it stays there for at least 4 years. So we want to look through cyclical fluctuations, liquidity shocks that might affect some sectors. These are like persistently zombie firms that are not created during recessions in a way that there is a bad shock and they might stay there for a couple of years, but we want a longer period. So we show in the paper that these zombie firms invest less, financially fragile, also face a slightly higher cost of debt than non-zombies, and they typically do not recover over time. So it's quite persistent, the weakness. So this is not firms that are facing temporary liquidity shocks. But still, our definition is consistent with an interest rate subsidy, which has been used by Caballero, by Acharya, that imposed that a zombie firm gets credit at a rate lower than a triple-rated firm. So we don't impose this. There are several papers already showing evidence that zombie firms pay a higher cost of debt. What we show is that given their weak balance sheet, they would have paid a much higher interest rate. So there is an implicit subsidy there. But still, in absolute terms, they pay higher than non-zombies. Okay, let me now go into the shocks part. So it's very difficult to come up with these beautiful high-frequency monetary policy shocks for 47 countries. Many emerging markets, they don't have deep markets, they don't have the data, this intradaily data. So what we do is to resort to this US global spillovers literature. So there are similar papers, including from Jordan, that explore the trilemma, but they cannot use these shocks for countries with exchange rate, with capital flow measures, capital controls, or fixed exchange rates. In our framework, we can do that because we use the US monetary policy surprises. So on the left side, there is a contractionary shock, which affects the foreign interest rates across the yield curve, leads to a decline in risk in the price of risky assets, and this affects the borrowing costs in the rest of the world. And then we are interested in the zombie versus non-zombie differential effect. And so what we do is, for each one of the countries, we take the monetary policy indicator, standard by now, which is the 1-year government bond yield, for country C and time t, and for each one, we regress this on several X country-specific controls. that capture trade, exchange rate channels, and economic conditions. And we regress this on the delta on ST. ST is the US surprise. And the delta C is allowed to be heterogeneous across countries. So the sensitivity of country-specific conditions are allowed to be different when you have a contractionary monetary policy shock. If you want, you can think about this term as a type of Bartik type shift share instrument, where you have an exogenous shock, so the US monetary policy surprise, and you have the sensitivity, which is the share in the Bartik type instrument. And this is the type of second stage regressions that we are going to run at the firm level. So we have on the left-hand side, this is local projections, the cumulative change in investment, employment, debt, and also the interest rate. So we want to capture the real side with investment in employment and credit conditions with debt and interest rate. And what we are interested in here is the interaction term between the zombie dummy predetermined. So this is the zombie, the binary variable for each one of the firms where it's classified as zombie or not predetermined. And we interact with our shock from the third stage regression, the country specific. And here, since we add, standard firm level controls, and we have the country sector time fixed effects there in the second term. This is very important because in the paper we show the average effect, that there is well-behaved shock, but then we are after the differential effect. So we, after controlling for, shocks, time varying at the country and sector level, we want to make sure that the response of zombie firms to a contractionary monetary policy shock, it's not due to shocks happening at the sectoral level, for instance. And we make sure that we compare zombie firms with the relevant peers. So we have in the same country and sector. So what we find is, remember that the average effect is negative, that I haven't shown here, but well-behaved responses. A positive coefficient means that zombie firms' investment and employment, it's less affected. So it's not that it's positive relative to non-zombies. So they are less affected, which is surprising at face value. And when I run the same type of regressions with debt and interest rate, we see that potentially, we don't control for credit supply effects. This goes to the syndicated loan market in a minute. But here there is a tentative already suggestion that they are able to mitigate the impact on investment and employment because relative to non-zombies, they decline debt by less and they have a smaller pass-through of interest rates. And one of the possibilities is, but okay, wait a minute. We know from the literature, the financial constraints, that typically financial constrained firms, they respond more. So we try to differentiate zombies from those firms. What we do in the third term, for the lack of a better term, I call it distressed profitable. So we're going to turn off the profitability criteria that we had in the zombie definition. We had 3 indicators, and the third one, they're going to be ICR below 1, they have high leverage, but they are profitable. And we are going to compare zombies relative to these guys. And again, we get very similar response. So zombie firms are less responsive relative to these financially constrained firms, but they are profitable. So in the model, we also rationalize this, that a firm that is profitable gets offered the market interest rate because they generate profits, they can pay back the debt. Zombie firms in our model, and also empirically, they shift to the probability of default region. They will default if they get the full pass-through of the interest rate. So lenders, knowing that, assuming that they know the probability of default region of the zombies, they will offer better credit conditions. The interest rate goes up, but by less. Now, of course, the criticisms that I get, and it's fair up to a point, is we don't know whether this is credit demand or credit supply effects, since I only have balance sheet data, borrower's balance sheet. Here, we try to tackle that question. So we go to the syndicated loan market and we run similar regressions, but now on the log of new loans. And again, we control for a bunch of fixed effects, including the last one. for those of you familiar, this controls for credit demand when you cannot use the Quadjamian fixed effect. It's the industry, location, size, time fixed effects. This tries to assume that credit demand is similar for firms that are in the same industry, in the same country, and of a relatively similar size. And what we find is that when there is a contractionary monetary policy shock, zombie firms get roughly 7% more new loans. And this is controlling with a bunch of fixed effects, including when I saturate this with bankier fixed effects. So time varying credit supply effect, the result is still there. So it's 8%. So when we go to the syndicated loan market, the story here seems indeed that lenders, when there is a contractionary shock, shift lending relatively more to zombie firms. And so the first two columns are the same. And now since we merge the data with bank capital ratios at the bank level, you see that the observations drop substantially because I don't have capital ratios for all of these countries. But what we are going after is the triple interaction term, the last one, which is which type of banks, when we split by high versus low capital, so we take the median of the tier one capital ratio in each one of the countries, so we split the banks like that, and we're trying to understand where is most of the lending coming from. And the last interaction term tells me that when there is a contractionary monetary policy shock, low capitalized banks, they are the ones providing differentially more lending to zombie firms. Again, we have a theoretical underpinning for that, but also here I can suggest that the story seems really that the incentives, these evergreen incentives, are relatively stronger for banks that are close to breaching the regulatory limit. So for some reason, they made credit decisions in the past. There is a higher cost of debt. And if they were to pass through fully, these zombie firms, some of them would default, not be able to pay back the debt. So there's an incentive to evergreen the old loan with a new loan. And we get the same result, 3 minutes, yeah. We get the same result when in this type of specifications, I can use the Quadjamian fixed effect, just a nerdy thing, but the magnitude is slightly bigger, but the result is still there, that low capitalized banks are the ones providing more the lending to zombie firms. Now, just one slide on why this matters, and this departs, I would say, a bit from the causal interpretation, but I thought it was helpful to have like some kind of aggregate effects. So here I'm asking a lot from you, but bear with me. So country level specifications where I have the monetary policy shock interacted with the zombie share. Here I'm trying to understand what are the impacts on GDP, inflation for countries with a one standard deviation increase in the zombie share. Of course, there are many other factors that affect GDP, but I'm showing you here that potentially countries with a higher zombie share, they tend to have lower GDP growth and lower inflation. Lower inflation is consistent with the story where you keep these bad firms alive, you have oversupply that puts downward pressure on prices. And the GDP growth story here is the misallocation of capital and credit, which affects investment, TFP, and GDP growth. The silver lining, and I think I'm about to finish, is let's look at heterogeneous effects across countries. And here in this kind of monster of equation, I'm going to look at the differential effect for countries that have higher capital buffers. So we construct capital buffers at the country level by taking the average capital ratios with the risk-weighted capital requirements from the World Bank survey. And we are trying to see whether higher capital ratios or higher capital buffers allow or help to mitigate the zombie lending. So this differential effect. Again, when you start playing with many interaction terms, I have an increase in the confidence bands, but there is some tentative evidence in countries with higher capital buffers, this zombie lending distortion or behavior tends to be mitigated relative to non-zombies. The result is better when I split countries by high versus low NPLs. In the annex, I also have the results on macropru. So on macropru, I find that policies that target limits to credit growth, credit supply, these countries in general tend to have fewer problems with this zombie lending affecting non-zombies. Bunch of robustness, happy to follow up if my discussant has questions on this. But let me conclude by saying that, you know, when we did this, we found it surprising that zombie firms are less responsive to monetary policy shocks relative to other firms, and this can indeed hamper the effectiveness of monetary policy transmission, since there are incentives of banks to shift lending to the less productive firms and also not to provide the full pass-through of interest rates. So this is positive in the short term, because you keep insolvencies down, especially when you have a huge fall in demand. But over the medium long term, this doesn't allow this creative destruction process of zombie firms being replaced by new, more productive firms. The silver lining there that we find, and also I didn't mention the efficient resolution of weak firms, we have also results in the paper. And let me finish by saying something that I should have started with, is this paper, one of the conclusions is monetary policy is not the right tool to address zombification. So according to our results, should focus on their mandate, but bear in mind that it might create these distortions in lenders. We need to work with macroprudential policies to increase the resilience of the financial sector, to also improve insolvency frameworks so that these firms can be resolved faster and at a low cost for lenders. Thank you.
Discussant is Enrico Sette from Banca d'Italia.
So I would like to thank the organizers for inviting me to discuss this very nice paper. Okay, I'm with Bank of Italy and CPR, and of course the usual disclaimer applies. So just to briefly summarize the paper, although Bruno did a very good job, I think, in illustrating the main results and the methodology. So this paper addresses the following questions. Do banks transmit monetary policy differently to zombie and healthy firms? And the idea is that banks can be reluctant to pass through interest rate increases to zombie firms for fear that higher interest expenses may lead to zombie firms to default, relatively more than healthy firms. The paper provides evidence from a panel of countries applying a local projection IV approach, and also from Discussant that includes data from syndicated loans. It has a large set of countries, 47 countries, observed for 20 years between 2000 and 2019. The paper also has a model, which is an extension of the paper by Miguel Faria y Castro and co-authors, which is consistent with the empirical results. There is also some evidence that macroprudential policies are effective in reducing this behavior of banks towards zombie firms. So let me summarize the main results in two pictures. The first is like the average effect that Bruno didn't have time to show. So expected behavior following a tightening of monetary policy. Let me start from the financial side. There is a drop in the growth of debt and higher interest rate changes to non-financial firms overall for the average firm, then a negative impact on investment that somehow reverses after a few quarters, and limited effect on employment growth. But then the key results of the paper are in this slide that show the differential effects between zombies and non-zombie firms. And again, starting from the last two panels, you can see that on the financial side, debt of zombie firms grow relatively more than that of healthy firms, and the interest rate change is smaller for zombie firms than for healthy firms. So I think the paper is very nice, it's well done, very careful, and deals with a very important topic. it contributes to literature that is quite crowded, but interestingly, in my view, it finds a new angle. And also, it contains some important implications for the policy debate on the effects of monetary policy on zombie firms and on the zombification of the economy, and potentially more generally on real effects of monetary policy. So my comments are going to focus basically on 3 areas. The first is some suggestion to try to better nail down the mechanism, then a few technical issues, and finally, policy implications and the relation with the literature. So let me start from the first comment, yes. So I'm going to focus on the transmission through interest rates, but of course this applies also to the transmission through credit quantities. So for interest rates, I mean, we can distinguish the interest rate on a loan, on a reference rate, and the spread. The reference rate, of course, changes for adjustable rate loans. It's fixed, at least for a while, for fixed rate loans. So among the reasons for heterogeneous transmission across zombie and non-zombie firms are that banks can change the spread differently, or banks can apply a different reference rate to the 2 types of firms. Then, of course, this can occur because banks want to reduce the chances that zombies default, and this is the story of this paper. But then potentially there can be some hidden sources of heterogeneity that drive this behavior. For example, zombies can take different loans, for example, typically more shorter terms or more easily securitizable, potentially term loans versus credit lines. Also, zombie firms could also have more collateral, and this could be the case because the descriptive statistics suggest that they have more tangible assets than healthy firms. But then these issues can be addressed in the paper, and my first suggestion is to exploit more the syndicated loan data, for example, by also showing the transmission to interest rates in addition to the effects on credit quantity, and also by controlling for the maturity of the loan, for the loan type, for the presence of collateral, and potentially also to look for loan renegotiations. All these are potential sources of heterogeneous transmission of a monetary policy shock onto credit supply, and the paper can actually do something more to control for these possibilities. The first, the other points are in this slide. So the first additional issue, in my opinion, is whether these effects are symmetric. So the paper focuses a lot on interest rate increases, but it would be nice to understand whether banks behave in the same way or differently when there are interest rate cuts. And also, I think the paper can relate to 2 relevant papers here. The first is Ottonello and Wimberry, a macro paper on econometrica that actually shows that low-risk firms are more responsive to monetary policy shocks because they face a flatter marginal cost curve for financing investment. And the reason is that low-risk firms are less credit constrained. The macro paper by Ottonello and Wimberry actually takes this as a black box, but the paper by Bruno and Chenyu can actually provide a micro foundation for what the paper finds and argues. The second paper is by Kinda-Hakem. It's a theory paper showing that relationship lending somehow smooths the transmission of monetary policy. So relationship lenders transmit less rate hikes to relationship borrowers, but they also transmit less rate cuts. So I think the relationship between relationship lending and zombie lending sometimes is blurred. One could also argue that zombie lending is a kind of degeneration of relationship lending, but then this paper could actually provide empirical evidence for the theory work by Kinda-Hakem by showing that indeed banks engage in loan evergreening relatively more by transmitting monetary policy differentially across healthy and zombie firms. Then I have a further small comment related to a technical aspect. Bruno and Chenyu suggest that firms in emerging markets often have foreign liabilities in foreign currency, typically in US dollars. It would be important potentially to control for this possibility, also because zombie firms are more prevalent in non-tradable sectors. And therefore they may have fewer dollar-denominated liabilities that then are like are adjusted differentially to changes in monetary policy, especially when US monetary policy is used as an instrument for local monetary policy changes. And I'm about to conclude with a few thoughts about the policy implications of this paper, which I think are quite rich. The first is that basically a key result is that banks charge relatively lower rates to zombies, and therefore they're gonna have lower net interest margin. These banks then are leaving some money on the table, potentially having lower overall profits. And since the banks that typically have more zombies in their portfolio are lowly capitalized banks, then basically this paper is suggesting a mechanism for which zombie lending perpetuates the low capitalization of banks. A second implication has to do with the relationship with the literature. There's a large literature by now that links zombie lending and like the proliferation of zombie firms to excessively accommodative monetary policy, but also through positive shocks to interest rates. I mean, positive in the sense policies that make monetary policies especially accommodative. This paper actually shows that banks also engage in zombie lending when monetary policy tightens. So I reconcile all these pieces of evidence in the fact that when banks have incentives to engage in zombie lending, they are going to do that irrespective of whether we are in a phase of tightening or in a phase of easing. And then, and I think this is an important conclusion of the paper, potentially monetary policy is not the right instrument to fight zombie lending, while instead more appropriate instruments are macroprudential policy, and there is a paper by Diana Bonfim that shows that indeed macroprudential supervision is effective in fighting zombie lending, and macroprudential policies, as this paper does. And I also find very important the result that if you take seriously the paper by Acharya et al., that zombie firms are deflationary, then basically the presence of zombie firms amplify the deflationary effect of a monetary tightening. Of course, this could be like a small benefit compared to the cost that zombie firms can impose on the economy, but it is something that should be taken into account when we evaluate the welfare effect of killing zombie firms in the economy. And I'm done. So I think this is a very interesting paper. I really enjoyed reading it with very relevant policy implication. And thank you very much for your attention.
Thank you. We have some time for questions. Marcus, anybody online? No, again, not. So wake them up, make some noise. So then Jean-David was the first, while the others gather their thoughts.
Very interesting paper. This question maybe is for your previous paper. I'm not sure, but out of curiosity, what's the NPV or the Sharpe ratio of subsidizing this firm for a bank? Is it much more profitable than investing in other types of of assets? Thank you.
Livio.
Thank you. I think it's a great paper. But, I was wondering, so this, you seem to treat the zombie versus non-zombie, the fixed finisher, but I guess they also transition. I mean, these firms, they may transition into being zombie, and also out of being zombie maybe as well. So how, I mean, I was not sure, from the paper how you deal with that. And also, I guess, my kind of Italian kind of experience background with, with zombies, tells me that there must be a lot of political reasons why these loans are extended. I remember our airline, if there was ever a zombie firm, that was it. And the banks were financing it for many years, and it was clearly a political deal. So I don't know if this changes the, your specification in any way, probably not. But just to be all of us be aware that this lending happens for political reasons, probably, and not for kind of rational calculus. Yeah.
Don't remind me, Livio, what Lufthansa is buying. So, any other question?
I have a question.
Oh, okay, sorry, I should have looked
So
right.
thank you, Bruno, for the nice presentation. I was wondering, I mean, given that you have cross-country heterogeneity, if there is any role, for instance, for things like the time needed to resolve NPLs, so in different countries, or bankruptcy procedures, which might be very different across countries. Thank you.
Oh, yes. A prize for one online question. Marcus will read it out. Please give him the mic. Yeah, thank you.
So we have a question from Tobias Herbst, and he's asking if banks keep interest rates low for zombie firms to prevent them from defaulting, why use the zombie indicator in the regression rather than the PD straight away?
4 questions, 4 minutes. Is that a deal?
Always Thank you a lot for your comments. I mean, I was very afraid to get comments from an expert on zombie, and I think you can reply Livio's question because you have a paper on zombie firms in Italy. So,
Okay.
no, thanks a lot. Points well taken on the syndicated loans. I think this is like the newish part so that we can explore. Initially, we didn't have in the paper, and then people were asking about whether it's credit supply, whether it's credit demand, and maturity, loan type, renegotiation, transmission to rates. Yeah, we're going to try that. Thank you so much. Including the relationship lending. This is the only part where I can actually know the relationship lending and not just with the Compustat data set. So I took note, we haven't done it. On the asymmetry effects, we haven't done it, but my answer from the theoretical model is that it should be asymmetric, because if in a static world where interest rates do not change, business continue as usual, right? So they provide lending to zombies or not zombies, but this is like a bank level decision. The issue is when the cost of that goes up, and if the banks need to, in the model, also we see in the data, if they need to implement the full pass-through, they might not be able. In the model, they shift many to the probability of default, to the area of default, not probability. And so banks, they need to evergreen. Where in a world where you have interest rate cuts, absent other shocks, the zombie firms, banks don't need to shift differentially more lending to the zombie firms relative to non-zombies, because the cost of that is even lower. But we haven't tested empirically. Thanks. Point well taken on the Bruno and Chenyu paper. As you mentioned, many of these firms are in the non-tradable sector and smaller, but I need to see how to check the foreign currency composition. Thank you for the implications. I'm gonna borrow many of your arguments for the paper. I think it's very nice. There is a price to pay of having deflationary effects, right? So it helps, but there is a financial stability cost. And also thinking about the long-term productivity growth. That's the point that I make about fine, in the short term, inflation goes down, you avoid a massive wave of insolvencies, but I think this is relevant for Europe, right? The TFP, this is bad, right? So this is one of the cost to pay. Then I got I haven't done it, what you are suggesting. We do something else in the paper, which is try to compare the interest rate risk adjusted. So what they are charging to the zombies is way lower than what they would need to charge in order to equalize the risk adjusted return on a loan to a non-zombie. So the reason why we talk about implicit credit subsidy. So even if they charge higher, this is bad when it's like risk adjusted. Livia's question, we do have the transition matrix in the empirics. We have the subscript T. So there is they are allowed to transition. It's very slow also kind of by construction, right? That I impose a 2-year plus 2-year. We have in the paper, I think not in this one, in the previous one, that roughly 70 to 80% of the zombie firms remain zombies in the next period. And some of them exit, like also non-zombies. But the transition from, if I remember, from zombies to non-zombies from 1 year to the other one is very small, like 4 or 5%. So, but I allowed this, this transition to occur in the model. And going back to the question you asked on Italy, so this is something that we cannot do, but others have done. Try to remember the paper for India, that they find that state-owned banks provide more lending to zombie firms. So there is a political kind of guidance, and there are like papers on the margin that also, not on zombies specifically, but more on weakness in the non-financial corporate sector, that link to political connections. So firms that have a strong political connection, even if they are not state-owned, you also see weakness in productivity and stronger credit. So maybe it speaks a bit to your question. Katerina, we have the result in the paper. I couldn't present it. It's tentative, but we explore an indicator that the fund constructed like 2 years ago, which is called the Crisis Preparedness Indicator. This measures the state of insolvency frameworks, bankruptcy laws, and etc. across many, many countries. So we take that and we find that countries that have, for instance, out-of-court restructuring, which is very developed, it's less costly. It's fast because you don't need to go through, the formal procedure. Like the US ranks very high on that. In the US, I tend to say that the firm doesn't die, but is reborn. I think in many countries in Europe, when a firm is resolved, it dies. And this encourages banks because it's costly, it's lengthy. At the extreme, banks will not recover any of the assets, so they will take that into account. I think I show in the paper that this discourages, in a way, just writing off the loan because it's not an efficient resolution mechanism. The US I always give is the extreme, right? It's very fast, so you made a bad decision in the past. If you have capital to absorb that, write it off, and the firm can be resolved, and the recovery rate of the loan is high. And the last question was online, so I want to address this one. And I don't use probability of default directly because it's not the same thing. So these zombie firms, so some of the firms, the other way around, some of the firms that have a high PD, they are profitable. They are not financially distressed, but for some reason they are like young firms. And when you compute the PD, which is not without problems, so you might capture good firms. We do find a correlation that zombie firms tend in general to have a higher PD, but also in the theoretical model, the PD is not the variable that banks look at. They look at leverage, profitability, and then they know the probability of default region. But just using the PD is not the same thing in our model. And I finish here.
Excellent. Maybe give a hand to the authors and the discussant for a very nice discussion.